While most investors buy and sell on North American exchanges from 9:30 a.m. to 4 p.m. Eastern Standard Time, Monday to Friday, some trade outside this period. This is called extended hours trading. On major U.S. markets only, investors can trade before the market opens, between 8 and 9:20 a.m., and after it closes, between 4 and 7 p.m. on WebBroker. One of the main reasons someone might trade during extended hours is to quickly respond to sudden market changes or news about a company, like a merger or earnings announcement. Depending on the news, a stock's price can respond positively or negatively and impact the direction before the start of the next regular trading session. For example, if a better than expected earnings report is released after hours, it may create a demand for shares and a bump in the company's stock price. But a negative report could lead the stock to dip. Another potential reason to trade outside regular hours could be if the price of a security was reacting to changes in an overseas market with different trading hours. For example, a company with close ties to the Asian markets may experience price fluctuations during extended hours trading. Extended hours trading may give you an opportunity to act on something quickly, but keep in mind that by doing this, additional factors should be considered, like high volatility, which can lead to big price swings in either direction. Volume in extended hours is considerably lower than in the regular session, so this can cause a stock's bid and ask prices to widen. This could make it more challenging to buy and sell at your desired prices. However, a stock price can become more volatile during extended hours if, for example, a company announces it is being bought out by another company. At this time, the volume may spike and cause higher than normal swings in either direction. Another factor is low liquidity. Liquidity is how easily something can be turned into cash. Let's pause and look at this for a minute. If there is high demand for something, then it can have an easier time being sold for cash. For example, a home listing with multiple offers to buy likely means the seller can not only convert the house to cash, but they may also sell the home at a more desirable price. In terms of investing, since liquidity is driven by supply and demand, you can see this reflected in the bid and ask prices of a security. If the spread or gap between what a buyer is willing to pay for the security and what a seller is willing to accept for the security is small, then the investment is considered liquid. Generally speaking, the more buyers and sellers, the higher the trading volume and the tighter the spreads. For example, if ABC1 stock has a bid price of $55 and an ask price of $55.01, then this security has a relatively small spread. This stock can be considered liquid. But if the spread were wider, like $50 and $60, then this stock would be considered relatively illiquid, the opposite of liquid. In other words, it may be harder to sell the security at desired prices because the number of people trading the stock is relatively low. Because liquidity and trade volume are relatively lower in the pre-market and after-hours trading sessions, only limit orders are allowed during extended hours. With the limit order, you can enter the maximum price you are willing to pay on a buy order or the minimum price you're willing to accept on a sell order. This may help minimize the risk of executing a trade with an unexpected and less attractive price. If you want to buy and sell during extended hours trading, you can do this on WebBroker and pay the same online commission. Once you know which US stock you want to buy or sell, you will need to pull a quote. Be aware that the last traded price on WebBroker does not factor into trades that are placed in the extended hours. To get an indication of what a stock is trading for in the pre-market or after hours, you will need to refer to the bid-ask price on your quote. Next, you will pull up an order and select Limit as the price type. In the Good Till drop-down menu, you will select Day plus Extended Markets. Day plus Extended means the order is active for the remainder of the trading day, as well as the next extended trading hours period. For example, if you enter a Day plus Extended Markets order at 2 p.m. on a Wednesday, then the order will work for the remainder of the official trading day hours, 2 to 4 p.m., and after hours as well, from 4 to 7 p.m. If you enter the order during pre-market hours, like at 8:30 a.m., then it will be active for that extended trading period until 9:20 a.m., and then again during regular market hours from 9:30 to 4, as well as carry into after-hours trading from 4 to 7 p.m. If the order hasn't been filled by 7 p.m., It will expire and you may need to re-enter it. If the order is open and you change your mind, you can always modify or cancel it. In summary, extended hours orders may be a convenient option to consider if you wish to trade outside of regular market hours.